The Bank of England has kept the interest rate on hold at 4%. Analysts are now predicting a potential cut in the Bank of England base rate in December, once the impact of the November the 26th budget becomes clearer. The rate acts as a guide for banks and other lenders, and it hasn't been below 4% since the start of 2023. Our economics and data editor, Ed Conway, has sat down with the Bank of England governor today and began by asking him whether Rachel Reeves' forthcoming budget played a part in the decision today.
No, I mean, we know one thing with certainty: there's going to be a budget delivered by the Chancellor on the 26th, I think, of November. And obviously we'll have our next meeting in December, so we'll be able to factor the budget into our consideration then. But until then, and at this meeting, we condition our view of monetary policy on what is the currently announced fiscal policy, which is obviously the spring statement.
Do you have any advice for the Chancellor? And one of the things that she's talking about is trying to make this non-inflationary. And I know that, you're not trying to set tax policy here, but are there any things that that are inflationary when it comes to taxes or indeed spending that she should be a bit wary of?
Well, I'm not going to use my public pulpit to give advice to the Chancellor because
I understand that,
I think that's.
Do you see my point there?
Yeah. Well, obviously, we have had this what we tend to call the hump in inflation this year. It's gone up. I do think we're now at the top, and the top turned out to be a little bit lower than we thought it would be in August, which is encouraging. And we have done, as we've done it again today, is do the analysis to sort of break down the components of that hump. One of the components is what we call administered prices. Now, these come from, I mean, they're not all coming from one part, but they're coming from sort of the broad sort of set of prices that are in some sense set, with some public policy objectives, some public sector.
Water bills, things like that.
Water bills, vehicle excise duty, bus fares, these sorts of things. Now, it's not for us to intervene. All of these reflect other public policy objectives. So, fixing the water system, I do not for a moment want to suggest isn't important, because it is. We have pointed out, though, the impact that these things have on prices. And I think that's important. Obviously, it's our job to deal with it in the sense that it affects inflation. It can potentially become more persistent. But that's it, really.
Okay. Previous budgets, last year's budget, that was a bit inflationary, wasn't it? Well,
one of the things we've spent a lot of time on this year, and I spent a lot of time when I'm going around the country talking to businesses, is what is the pass-through of the national insurance? How are they passing through the national insurance? Change, which obviously has increased the cost of business, and I can tell you it's obviously a subject of discussion. I think every business group and every business I see, it comes up. There's a menu of things that they can and have done, and they're not mutually exclusive. So firms have approached it in different ways depending on their situation. And I would say, earlier this year we were very much getting the response from businesses, when the menu is laid out, tick all boxes. I think that's still to a considerable degree the case, but I think probably my own assessment would be that there's a bit more weight on the reducing employment. Some firms have also said, look, our wage settlement was lower than it would have been had it not happened. That obviously also, though, depends on how the national living wage features in your sort of in the mix of your pay bill.
You talked about inflation. So inflation 3.8%. Your target is 2%.
Yes.
It's the highest in the G7,
yes.
And it has been for quite a while. Does that give you some nerves, being an outlier there, the UK with the highest inflation?
Our job is to get it down to 2%, and that's what we'll do.
But it's not. I mean, but you've been saying that with respect. You've been saying that for a while.
We did have it at 2%. Bit over a year ago. Now we were all, I remember saying at that time when we did these reports, when we published our quarterly reports, that we were concerned that it wouldn't stay there because we were getting these very big, what we tend to call arithmetic base effects. So having had energy prices go up so far, they came down quite quickly actually, and that tends to put negative sort of impetus. But when that all sort of bottoms out and levels out again, that it wasn't going to settle necessarily, and therefore we had more work to do. And then we have had some other factors contributing to this hump. So our job is to get it back down again, and we will do that.
Interest rate cuts. Can we still expect there are going to be cuts to come?
Well, I've used the phrase today, a gradual downward path, and I think that's very good way of describing it. So I do think that the path will be downwards. What I think is very uncertain at the moment is if you ask me the question, which would be the follow-up, when and by how much, then I think on both counts, we've got to see how the evidence evolves.
Right, so you could have to wait 2 years for the next cut, potentially?
No.
No, okay, well that's a bit clearer.
I don't expect that.
Okay, all right, but so a few months.
I'm not going to give you a prediction. I think 2 years I can safely answer that question.
You're clear about that. So food inflation is a big part of this, and I think there's a kind of broader issue here, which is that for a lot of people, it doesn't feel like the cost of living crisis is over. It feels when they go to supermarkets like prices are much higher than they're used to.
Yeah.
What do you say to them? I mean, this is not a macroeconomic kind of point, but just to people who are really struggling and thinking, and they're calibrating as well. They're thinking about what's happening to prices. What's your message to them right now? Because they're kind of expecting inflation to stay high, given what they're experiencing.
Well, first of all, I mean, I very much understand the situation they see and how it affects them. I mean, I'm extremely sympathetic to this, and it is obviously a difficult situation for many people. I think it is important to distinguish the cost of living from inflation in that sense, because you put it well. Inflation, of course, is about the rate of change of prices. When people think about the cost of living, as you mentioned, it's about the level of prices. So we could have inflation come right back to target. That wouldn't, of course, lead to lower prices. It would actually stop the increase in prices that we don't want to see. So I do have to make that distinction. We can't give people promises that prices will come down. That's not our job.
But you are making a pledge that you're going to bring inflation down to 2%.
Yes.
And you think we're now past this hump. 3.8% is coming down now.
That's my expectation. Having said that, we've had one number that has come in under where we thought it would be. That's obviously good news, and it was quite a broad base of components of the index. That's good news too. It wasn't one particular erratic bit of the index. It was broadly based. But I am going to I want to see some more supporting evidence for this. I'm encouraged. I think the risks are now much more balanced than I thought they were when we last produced a report back in August. So I'm encouraged in that sense. I think there is real source for encouragement, but I do want to see some more evidence. Good to see you.